But let me just say that Shin is the Hughes-Rogers Professor of Economics and is the Associate Chair of the Economics Department here at Princeton University. And prior to coming to Princeton, Hyun was the Professor of Finance at the London School of Economics. Professor Shin's current research includes financial economics with particular interest in financial institutions, disclosures, and risk and stability issues. Professor, you're up.
Thank you, Rich. It's really a great privilege to be able to chair this session. So this is going to be called the Anatomy of the Mortgage Crisis, and it's going to set the stage for the more policy-oriented session that we're going to see later. And we have a very distinguished panel this morning. And what we're trying to do is to give you a broad background into the origins and the mechanisms through which the mortgage crisis actually propagated. Mark Zandi, I'm sure you will have seen his columns already. He's one of the foremost commentators on this issue, and he's the chief economist and one of the co-founders of Moody's Economist.com, economy.com. And I suppose, he's probably the best person to tell us about the outlook for the economy and the way that the economy and the financial system interact. So Mark's going to tell us something about the way that the mortgage crisis will impact on the real economy and how that rebounds on the financial system. Eric Groshen, to my right, is a vice president and the director of regional affairs for the Federal Reserve Bank of New York. So she's the eyes and ears of the Federal Reserve System on the real economy in the second district, which is the district that the New York Fed oversees. She's also a member of the Fed's coordinating committee on home ownership and mortgage distress. And so she's one of the best qualified people that I can think of who can tell us about the policy response from the Fed and other policymakers in dealing with the distress that comes from mortgage foreclosures and other fallout from the mortgage crisis. David Wilcox, who has abandoned us, but who's there sitting in front, is a very experienced policymaker from the Federal Reserve Board at the Board of Governors in Washington, and he is a senior staff member of the Fed Board. He's deputy director of the Division of Research and Statistics, and he's had a very extensive experience across all areas of policymaking at the Fed. And David's going to tell us about the role, the current thinking behind the Treasury's TARP program, the Troubled Assets Relief Program, and how it's gone from TARP 1, which was initially about buying up toxic mortgages, and how it has now evolved into so-called TARP 2, which is a more response in terms of buying stakes in the banking system through equity injection. Now, and we're going to speak in this sequence. But before I hand over to Mark, I thought it'd be a good idea to give you a further background from, if you like, a very basic background in terms of the financial market development context and how the mortgage crisis is part of the great transformation of the U.S. financial system. And this is really a rather striking chart. This is for the U.S. On the relative sizes of the relative growth rates of various sectors of the U.S. economy. And I've plotted here 4 sectors: the non-financial corporate sector, household sector, commercial bank sector, and lastly the broker-dealer sector. And this is the sector that's really shooting up here. And we're going back to 1952, and I've just set the figure at 1 arbitrarily at 1952, just to give you a sense of how quickly these sectors have grown. And you can see that since 1952, these three sectors, other than the broker-dealer sector, have pretty much grown at a similar pace. They're about 80 times the size of where they were in 1952. But the broker-dealer sector is more like 800 times. So relatively speaking, it's grown tenfold relative to the other sectors. Now, this is somewhat striking, but you lose the detail here. So what I've done here is to plot the same chart, but the vertical axis here is in log scale, which means to say when you go up one block here, you're actually increasing the size tenfold. And what you can see is that until around 1980, these four sectors grew at very much a similar pace. So it wasn't that this very rapid increase in the broker-dealer sector happened from 1952. It really took off somewhere around here. You can see that there's a little bit of a kink in that even though they've kept pace until about 1980, even as the broker-dealer sector just took off, the other sectors grew at a slightly lower pace here. Now, what explains this? I think what explains this really is at the background of today's conference, which is the very rapid growth in securitization and in the transition from a bank-based system to a market-based financial system in the United States. This chart shows you the holdings of home mortgages by various classes of financial institutions in the US. And it goes back to around 1980. So this is the period pretty much when we see this divergence between the broker-dealer sector and the other sectors of the economy. And what happens is that, well, you can see that as recently as the 1980s, the bulk of the home mortgages were held on the bank's balance sheets. So the green line here is the $1 trillion worth of, is the holdings in trillions of dollars of home mortgages on the balance sheets of savings institutions, your traditional banks. And the other sectors, the other institutions really had a much lower holding of these mortgages. But what happens is that this black line just really creeps up and suddenly takes off. So this is the amount of mortgages held in the agency and the government-sponsored enterprise mortgage pools. So these are passive companies who hold mortgages on the asset side and then issue mortgage-backed securities on their liability side. So you can think of the black line as the asset side counterpart to the amount of Fannie Mae and Freddie Mac mortgage-backed securities that are in issuance. You can see that that really increases at a very rapid pace. Another very notable thing, and we'll come back to this many times, I think, today, is this green line here. Well, it didn't come out very well here, but it's meant to be dark green. This just comes from nowhere. Actually, it is literally zero around here. But then it increases rapidly. There's a little bit of kink. It really takes a much steeper trajectory around about 2002, 2003. This is the mortgages held in the so-called ABS issuers. And remember, these are home mortgages. And so these ABS issuers are the asset-backed security issuers. So these are, if you like, the private label mortgage pools. So these are the passive companies that issue mortgage-backed securities, but which are not part of the GSE mortgage issuing program. And if you like, this is the counterpart to the subprime and the Alt-A and the jumbo securitization mortgages. And you can see that that really increases very rapidly. It literally it overtakes the commercial bank series in the years running up to the current crisis. And if you add up the market-based holders of mortgages, that is to say the GSEs, the GSE mortgage pools, and the private label mortgage pools, and call them the market-based holders of mortgages, and then have everything else as the bank-based. You can see that in the early 80s, the bank-based holders really dominated the scene, but it gets overtaken around about 1990. And then it sort of languishes here. It's only 1/3 of the total stock of around $11 trillion of home mortgages. So this is a very significant transformation of the US financial system. It's driven by securitization. It's driven by access to funding other than depositors. And in particular, it's driven by access to funding to long-only investors, both in the US and in particular to investors outside the US. And I'll come back to this shortly, because it really tells us something about the way that we can imagine this crisis unfolding in the next couple of years. Why is the broker-dealer sector such an important sector? Well, because it is the counterpart to this transformation of the US economy from a bank base to a market base. And if you like, the market-based financial system is, the broker-dealer sector is a mirror onto this market-based financial system. And the notable thing about the broker-dealer sector is that because it is a market-based intermediary, it dances to the tune of market conditions. And you can see this by comparing the relative growth rates of assets between the broker-dealer sector and the traditional commercial bank sector. This is the quarterly, but annualized, so it's the quarterly series of annual growth rates of assets, where the red line here is the broker-dealer sector, and the blue line is the commercial bank sector. You can see that the broker-dealer sector is just much more sensitive to market development, so it's a much more volatile series. But not only that, if we were to magnify the blue line so that you can see the relative peaks and troughs of these two series, but you can see that they actually, not only is the red line much more variable, the blue line and the red line, they dance to a very different tune. You see that they, for example, in the recent few quarters, even as the broker-dealer sector has been contracting very rapidly, the commercial bank sector, if anything, has been increasing. And so this is the traditional role of the banks as the buffer to hardship out there. And you go to the bank manager and say, look, I'm in trouble, can you give me a loan? And the bank says, look, we are in a long-term relationship, so therefore, even though I'm suffering too, I will give you a loan. That's not the case, of course, in a market-based system, because the whole system moves to market conditions. And so when one institution is in trouble, everyone's in trouble, and therefore we have a collective contraction. You can see that they dance to a very different tune. What this means, of course, is that as we've gone from this blue line to the red line collectively as a system, the system has become much more sensitive to fluctuations in funding conditions and market conditions more generally. And one way you can illustrate this is to see how the balance sheets of the financial institutions vary to changes in market conditions. And one way of illustrating that is to contrast the changes in assets and the changes in leverage between different sectors. So this is a scatter chart of the change in leverage. So leverage is defined as the ratio of total assets to equity. So if you bought a house with a mortgage, then you're leveraged. Okay? What this shows is that the change in total assets and change in leverage is negatively related, which is to say, when I bought a house with a mortgage and my house price goes up, then of course my balance sheet becomes stronger and therefore my leverage comes down. And conversely, if my house price falls, then my balance sheet becomes weaker and therefore my leverage goes up. That's exactly what you see for the household sector. You see this negative relationship. For the non-financial corporate sector, it's less clear. And what this means is that for companies, they react much more sensitively to changes in assets. So, when asset prices are high and their balance sheets are strong, the company may take on more debt in response. And you can see that there is less of a reaction. It's still negative, but it's certainly much less obvious that it's negative. But the crucial point is that for the broker-dealer sector, it goes the other way. So for the broker-dealer sector, the change in leverage and the change in assets are positively related, which is to say, it's when balance sheets are large, when financial conditions are good, that you lever up. And so you have a double whammy here. So not only do you have growing balance sheets, you're actually more highly levered too. And the consequence of this is that on the way down, you have a double whammy coming down too. So when you're contracting assets and you're cutting off loans and so on, you're actually also trying to reduce your leverage too. You can see it much more clearly in the charts for these individual investment banks. So here are the then five standalone investment banks. And here I've included another one just for comparison. And you can see that the change in leverage and the change in asset growth are all positively related. And this is the weighted average of those five. And when leverage is pro-cyclical in a sense, there is a great scope for amplification, both on the way up and on the way down. Because during a boom time, so think back to 2003, 2004, when funding conditions were extremely ample, and you could, people were pretty much forcing mortgages down your throat. Right? You just had to go to an internet site, and there were, there were adverts for how you can, reduce your mortgage payments. In a boom time, of course, balance sheets are extremely strong, and it's especially the case when you have mark-to-market. So when you mark-to-market your balance sheet, favorable market conditions will lead to a much faster rate of equity growth relative to total assets. I mean, that's one of the definitions of leverage. When you're levered and asset prices are going up, your equity is increasing at a much faster rate than your total assets. And because banks are keen only to keep just the right amount of equity to take account of overall risk, you want to adjust your leverage. How do you want to do that? You want to increase your leverage in order that you can use up your equity capital in the most efficient way. So rather than just keeping idle capital on your balance sheet, you want to lever up and make that equity work for you. But of course, when you adjust leverage and you increase balance sheet size, that means you're making more loans, and those more loans will feed the asset price boom that was already in place. So we have this circle. So during this circle, of course, this feels like a very virtuous circle, because on the way up, everything feels good, and the regulators are happy because the banks seem to be extremely well capitalized, and everyone feels rich, and it sort of feels like a boom time. It's a virtuous circle in its outward appearance, but of course, this is the time when all the bad decisions are being made. So this is the time when balance sheets are expanding very rapidly. And balance sheet, if you think about as a balloon, you need assets to fill the balance sheet. So when balance sheets are expanding very quickly, you need to make loans fast enough so that you can fill up that expanding balloon. But what if all the prime borrowers already have a mortgage? Well, you have to lower your lending standards in order to find borrowers that you can lend to. And when you have this pro-cyclical amplification system, it's a very natural consequence that lending standards get lowered. And all the issues with the rating agencies and the originate and distribute model, one can think of very much as the symptoms of this underlying incentive. I think we can blame people for succumbing to temptations. But I think as policymakers, we also have to ask, why were those temptations there in the first place? And I think this is very much the consequence of this time. But unfortunately, even as we have this circle on the way up, we have this vicious circle on the way down. And what we've been seeing is this vicious circle on the way down, where we have asset prices falling. This leads to weaker balance sheets, increases in measured risks. Banks become more nervous. They don't want to lend anymore. So even as they were very keen to lend to you before, now they don't want to lend to you anymore. They want to instead cut down assets and reduce their leverage, which means that credit gets constricted and leads to this further downward spiral. So where are we? Now, Mark's going to tell us more about exactly where we are in this, but here are some charts for the delinquency rates for subprime mortgages by the vintage year. And notice the scale here. These are very high numbers. And delinquency here is defined as 60-day plus delinquency. And you can see that the mortgages that were originated in 2006, they suffered the most. It's slightly higher here, but in fact, most of the damage was done in 2006. And this is an indication of the fact that the whole subprime industry was premised on continually rising house prices. As soon as the house price dynamics reversed, we have this very rapid increase. The worrying phenomenon, more than the subprime actually has been pretty much now dealt with, in the sense that the subprime assets have been written down around $500 billion worth of write-downs have happened already, and a big chunk of that is the subprime mortgages. The more worrying phenomenon, I think, is the prime delinquencies. And what we see here is that we're now seeing a very sharp tick-up in the prime delinquencies. You can see that the scale here is very different. So this is of the order of 1 and 2% rather than 10 and 20%. But still, this is unprecedented. Of course, the prime mortgages are a much bigger chunk of the $11 trillion holding of mortgages out there. So potentially, this could be a far bigger hit. Now, the IMF was somewhat chided when it came out with this loss estimate in April of this year. So this was their loss estimate of $945 billion of U.S. loans and securities that were originated in the U.S. But they have now upped their estimate to $1.4 trillion, within the space of 6 months. And it seems that even as they were being chided for being too pessimistic, it seems that they were not pessimistic enough. And here is their breakdown. You can see that the red line, which is the breakdown in their new reports, this is their October report. The blue line is their early April report. The big increases are now on the corporate side and the consumer loans, okay, and commercial real estate and prime residential. So these are the areas which have now been suffering in the second round of the crisis. So initially it was just confined to the subprime sector. Now there's a decline in real activity, and that decline in real activity has rebounded onto the asset onto the asset quality of the traditional assets on the bank. So this is on the loans. Here are the losses for the securities. In terms of numbers, it's actually even larger. Although a lot of these securities are actually held by foreigners too. The big increases have to do with the prime mortgage-backed securities and high-grade corporates. So we're now seeing this distress seeping into the prime mortgage sector and also into the corporate sector. So this is potentially a somewhat worrying sign. This is just to put things into context, how large is this current crisis? If we believe the latest IMF numbers, how large is this current crisis compared to some of the other ones we've seen? Well, in terms of the raw loss estimates, it dwarfs the previous crises, like the Asian financial crisis, the Japanese banking crisis, and indeed the US savings and loans. But of course, these are very different times and across different contexts and across different size economies. And a more useful normalized measure would be how large are these losses relative to GDP. And the current US crisis, of course, is not as large as the Japanese crisis or indeed the Asian crisis. But we're getting to 10% of GDP, which is much larger than the savings and loans. If the IMF's estimate yesterday, so they came out with this bit of a shocker yesterday, actually. They had an update to the October World Economic Outlook and had a very, very pessimistic view of the world economy next year. Then 10% may be somewhat of an underestimate. Somewhat following on Congressman Leach's opening remarks, I think one of the things we have to watch out for is the external adjustment for the US. Because many of these securities were actually issued and now are being held by foreigners. So if we think about who holds the GSE debt, a lot of them are held by US leverage institutions. So here there'll be banks, brokers, hedge funds, and other ABS type institutions. And there are also institutions, insurance companies, mutual funds, and so on, who are non-levered. And there are households who hold directly. But this blue sliver is actually a very important sliver because the amount that is held by the rest of the world went up from around 500 billion to 1.5 trillion within the space of around 6 years. And in effect, it was the central banks of the creditor countries in Asia and the oil-producing countries which have fueled which have been funding the mortgage boom in the US. And you can see it also in the holdings of U.S. securities. So this is just the debt securities, not the U.S. stocks. So holding of U.S. debt securities subdivided into the sector that's issued them. The biggest increases, of course, have been in this blue thing, which is the government and the GSEs. And with the budget deficit that's looming, this is going to be a much bigger increase. But the sharpest increases were these capital markets. These, if you like, these are the private label mortgage-backed securities that were actually increasing 30-fold between 2002 and 2007. Now, the worry is that when we have a reversal or even a slower growth, this is going to have a repercussion on the availability of funding for mortgages in the U.S. Now, there's going to, so, you know, even a slowing down of this growth is going to be felt, I think, you know, very directly. One of the silver linings, of course, is that this is going to lead to a decline in the U.S. current account deficit, but that's actually very mixed news, because that means that the U.S. households have to save a lot more. They're going to have to save precisely at the time when the economy is going into a downturn. And the slow consumption growth is going to be a very important theme in the next couple of years. So let me hand it over to Mark, who's going to tell us in a bit more detail about the current state of the credit crisis. Mark.
Thank you, Professor. Thanks for the introduction, and I want to thank Richard for the opportunity to be here today. As you may be aware, I'm part of the Moody's organization, but none of this is my fault. I sold my company to Moody's 3 years ago, and they were not using my house price forecasts. They are now, so if we ever have another securitization, we're in good shape. In case you care, I got cash, not stock. A lot of good that's done me, though. I want to do three things in my remarks. First, I'm going to give you my take on how we got into this mess, and I'll go through that in a few minutes. The second thing is to consider what it means for the economy, the near-term economic outlook, and I'll give you my views on that. And then the third thing is talk a little bit about policy and what kinds of things policymakers can and should do in the context of obviously what's going to be a very difficult period for our economy. So first, how do we get into this mess? Well, it began with a housing boom and bust, and you can see the boom and bust, I think, quite clearly here. This is a measure of national house prices. It's the Case-Shiller National House Price Index. Its regional footprint is about 70% of the country, so it may overstate a bit the boom and the bust, but I think it does as good a job as any index at measuring what's going on. It is an index, so it's equal to 100 at the beginning of the decade, 2000 Q1, and you can see during the first half of the decade, national house prices nearly doubled. The absolute peak was in the first quarter of 2006. There are many reasons for the boom and the bubble in the mid part of the decade. So many reasons one could write a book about this, and I did. And if you want to raise my Amazon ranking, you know, please feel free. My publisher would be very happy about that. I'll distill it down into three things, just for sake of brevity. One, the process of securitization is broken. It's flawed. No one in the process is responsible for making sure, or was responsible for making sure, that the loans, the mortgage loans that were being made were good loans. And that includes the lender, the investment bank, the rating agency, the regulator, and even the global investor who scarfed up these securities. No one had an incentive, enough of an incentive to make sure the loans were good loans, and no one did. Second, lack of regulatory oversight. I think at the apex of the bubble in the mid part of the decade, there was literally no oversight, at least not of the mortgage market for various reasons, partly because the regulatory framework is broken. There was regulatory shopping. I think the deregulation which began in the Reagan administration started off as a good thing. Very clear that financial system was over-regulated. It was stifling innovation, resulting in higher costs for consumers for financial products. But by the mid part of this decade, the pendulum had swung too far, and regulators weren't engaged to the degree that they needed to be. And then third, flat-out hubris, a necessary condition for any bubble, and I think this qualifies, is overconfidence. House prices started to rise quickly early in the decade. They rose again and again, and people started forecasting with a ruler, thinking that house prices would rise very rapidly ad infinitum into the future. And once you buy into that forecast, then you do silly things. You flip homes, you don't regulate, you don't rate, you buy securities without doing due diligence. So I think hubris was clearly in play. We're now in a bust. You can see prices are down 20% from the peak, and prices are back to where they were in the first part of 2004. So any person any household that purchased a home during this period and didn't put anything down or put very little down is now underwater. The value of their home is less than the mortgage debt they owe on their home, and that's a precondition for default. It's not a sufficient condition, but it's certainly a necessary condition. And it has precipitated a mortgage crisis. We can see the number of first mortgage loan defaults here. This is very timely, high-quality data based on credit files. We take a large random sample of all the credit files in the country at the end of every month. The last data point is for the last week of September. And as of the last week of September, there were 2.825 million loans in default. And as you know, this is the first step in the foreclosure process. You go 30-day delinquent 60, 90, 120, and you get a notice of default. The foreclosure process starts, and it varies quite a bit state by state, but this is when the process begins. 3 waves of foreclosure. Wave 1 was 2006. This was the early payment defaulter. This was the flipper who got in to the market looking for a quick buck. The peak of the market was early 06 when the market turned. These folks turned the keys right back to the lenders. In many cases, not making a mortgage payment. It was very surprising how quickly foreclosures developed after the peak in housing values. Wave 2, that was 2007. This was the subprime ARM reset issue. Interest rates were still high. This was before the Federal Reserve had cut rates. LIBOR was still up. Most of these loans are 228 loans, 2-year fixed, and then they turn into, in many cases, 6-month LIBOR ARMs. Any loan that was originated in 2005 hit their first payment reset in 2007. The average monthly mortgage payment on those loans jumped $350, from $1,200 a month to $1,550 a month. And for many of those folks, this was financially untenable, and they defaulted. We're now in wave 3. Interest rates are lower, so the resetting isn't nearly the issue that it was this time last year. But wave 3 is the result of negative equity, all those homeowners that are underwater, combined with unemployment. And that's your sufficient condition for default. Necessary being you're underwater, some disruption to income, and you're in default, and that's what we're saying right now. The mortgage crisis has resulted in a surge of losses. Here's my guesstimate of the losses the financial system is going to suffer with, similar to the IMF estimates. If you total up all the losses here, I'm coming up with about $1.3 trillion at this point, and this assumes a 30% ultimately peak to trough decline in housing values. We're down 20%, so another 10%. It also assumes 15% decline in commercial real estate values peak to trough, and it assumes a peak unemployment rate of 7.8% in Q4 2009. So obviously the loss estimates are very sensitive to those assumptions. Anything worse than that, the losses jump quite quickly. You can see I've broken down the losses into those that are going to be suffered by banks. This used to say commercial banks and investment banks, but now it says banks. Other financial is hedge funds, pension funds, insurance companies, and government. That's Fannie, Freddie, and the FHA. The red part of the bar is the losses on residential mortgage assets, and that totals, you can see the back of the envelope calculation, just over $600 billion. I think there's roughly 15 million mortgage loans that were made during the period that pretty sketchy loans, high risk of default, subprime, Alt-A, jumbo loans. 40% of them will go through the entire foreclosure process, so they get the notice of default, they go all the way through to a foreclosure sale. So that's 6 million loans that go through the foreclosure process, and at the sale, the mortgage owner will lose about half the mortgage amount. So the average mortgage amount at origination was roughly $200,000. They'll get $100,000 back in the foreclosure. So the total loss will be about $600 billion. This is probably understating the case a bit. It doesn't. This is not including some of the prime loans that are now going bust. So throw in another 50, 100 billion for that, and you get to the red part of the bar. The good news here is that the financial system, as the professor has pointed out, has written down a big part of the red part of the bar. That's the good news. The bad news, unfortunately, is that the system still has to write down all of the other losses. We haven't really gotten to that yet. The consumer loans, mostly credit cards and vehicle loans, commercial mortgage loans, that's going to happen over the next couple, 3 years, and corporate debt, everything from junk corporate bonds to CLOs, so that's coming. Now, it's hard to pinpoint exactly when the financial crisis, which is now over a year old, devolved into a financial panic, and I think that's what we're in. I think that's a fair characterization of the environment that has prevailed over the past really 2 months now. There's an element of just sheer fear, of just irrational panic. If I were going to put my finger on it, it would probably be the weekend that the Treasury Department took over Fannie Mae and Freddie Mac. Now, one could argue that was a reasonable thing to do. I think once the Treasury and the Fed and other regulators got into the bowels of these institutions, they figured that they were barreling towards insolvency, and they were probably getting calls from global investors saying that the investors were going to stop buying the debt, so they felt like they had no choice. But once the Treasury and Fed did that, I think they crystallized in the minds of global investors that no financial institution was safe, that everyone was in play. In fact, the very next day after the nationalization, on that Monday, the weakest link in the financial system, Lehman Brothers, was in play. And it's debatable whether Lehman should have been helped out, or at least helped it avoid bankruptcy. You can see the arguments either way, but the decision was not to help them, and there was collateral damage. The major money market mutual fund who held Lehman paper had to write down that paper. They broke the buck, meaning that the value of their assets now fell below what investors had put into the fund. And I think this broke a psychological barrier for mom and pop investors, and the panic was on. Redemptions began in the money market mutual fund industry, and that took this to a whole other level, because that is a direct link between the financial system and the economy through the commercial paper market. Money market mutual funds hold 35–40% of all CP outstanding, and if they're not buying the CP, then big non-financial corporations are going to have trouble funding themselves, and that means real economic problems very rapidly, and therefore stock investors saw that, and everything came unraveled. The panic is past its worst. It's past its apex, in large part from due to the very aggressive, unprecedented response by the Federal Reserve and other global central banks. But it's not over. The best measure, I think, of this is the so-called TED spread, the difference in 3-month LIBOR and Treasury bill. LIBOR being the rate that banks charge each other for lending and borrowing. The Treasury bill, risk-free rate. So the difference, the spread, the TED spread, is a pretty good measure of the angst in the financial system. I'm showing this TED spread all the way back to 1990 to give you a sense of other financial crises that we've struggled through. You'll note that I cut off the axis here. The actual peak a couple of weeks ago was 450 basis points, 4.5 percentage points. But if I had actually put the scale up to 5% to get the line in the graph, all these other financial crises wouldn't have looked like crises. In fact, I'm not even sure they were crises in the context of what we're going through right now. The good news is that the TED spread is now falling. We're back, as of yesterday, I believe the spread was back closer to 200 basis points. So we're back within the axes of the chart. It's still inordinately high, signaling that the panic is still not over. I think we're headed in the right direction. I'm assuming that the panic will abate and fade by Christmas time, but that's still a key assumption. So that's my 3 cents on how we got into the mess that we're in, and it really is a mess. What does it all mean for the economy? None of it is good. The economy is deep in recession. In my view, the recession began a year ago, in late 2007. We had a bit of respite, as you can see here, in terms of GDP growth this summer, but that was largely the result of tax rebate checks that got mailed out in the second quarter of 2008. This shows real GDP growth quarter to quarter at an annualized pace. The blue bar represents what my forecast was prior to the panic, so this was in August of this year. And you can see I did expect the economy to kind of muddle its way through into 2009 and pick up some steam by this time next year. But now we're deeply engulfed in a recession, and if I were doing this forecast today, it would be significantly darker. I have 2% down on GDP in the current quarter, 1.5% down in Q1 09, but that just feels optimistic at this point. But regardless, we have another year of recession to go. What it means for unemployment, another good kind of benchmark for understanding what this all means, is that the unemployment rate will peak somewhere around 8%, probably late 09, more likely early 2010. Today, we got another read on the job market. The unemployment rate jumped to 6.5%. The low point was 4.4% back in March of 07. If we go from 4.4 to 8, that's a 3.6 percentage point jump in unemployment. That would put this recession in league with the worst recessions that we've experienced since World War II, the 70s recession, early 1980s recession. And again, standing here at this podium at this time, that feels optimistic to me. It feels like things could be measurably worse than that. I mentioned one key assumption, and that is that the financial panic will fade by the summer. That's key to this outlook. I'm assuming that. And I'm also assuming that we get a bigger policy response immediately over the next 3 to 6 months, and I'll talk about that in a few minutes. I want to talk, before I go to the policy response, I do want to sort of draw the link for you between what's going on in the financial system and the economy, and there are three key and now increasingly obvious links. The first is credit. There really is none. The banking system is in survival mode, and you can see that by the fact that they're tightening down aggressively on their lending standards now. This shows the net percent of lenders responding to a quarterly survey conducted by the Fed of senior loan officers at major commercial banks that say they're tightening their underwriting relative to the standards that prevailed in the previous quarter when they took the survey. I'm showing this for three types of assets: commercial mortgages, commercial mortgage loans, that's the red line; C&I loans, that's commercial industrial loans, these are loans to business people; and then credit cards, that's the green line. You can see that the net percent that are tightening, and this is the most recent survey data just came out over the last few days, so it's very timely data. It's now as tight as it's been since, I've got data all the way back to the savings and loan crisis of the early 1990s. One question the Fed has asked in this survey all the way back to the 60s, and that is, are you willing to make a consumer loan? And the percent that say that they are willing to make a consumer loan, as of the most recent survey, is the lowest it's been since Q2 1980. It might have been Q1 1980. That was the quarter in which President Carter imposed credit controls. So by law, you couldn't make a loan. So we're as tight as we've been since that period. Credit markets, the other source of capital, completely frozen, completely shut down. There has been no residential mortgage-backed securities issuance for 6 months, no commercial mortgage-backed securities issuance for 3-4 months, no junk bond issuance for 6-8 weeks, emerging debt issuance, muni bond issuance severely disrupted, a little bit of investment-grade corporate bond issuance, but very, very low. In fact, there was a week, I think a couple weeks ago, when there was, in fact, no bond issuance, nothing. And that is the first time in Moody's 100-plus history that has ever happened. Just to give you a sense of the magnitude of the credit crunch. So link one from the financial system to the economy is credit. The second is confidence. This is completely shattered confidence. My wife, who is an avid reader of the op-ed page of the New York Times, is now reading the business page first, which is a scary thing. She used to cut out every op-ed page article and put it on my nightstand to read, and we had to debate it before I went to sleep, which meant I wouldn't get to sleep. But now she's cutting out the business articles, and then I point out every once in a while I am quoted in those articles. So, honey, look. So believe me when I say, yeah. But anyway, confidence has been shattered. Consumer confidence is at an all-time low, according to the Conference Board survey, and business confidence has been completely pummeled. You can see that here. We conduct a weekly survey off of one of our websites. I have 400 to 500 respondents every week. They are in every industry in all parts of the world, and this shows the net percent of responses to the 9 questions that I asked in the survey that the net percent of businesses that are responding positively, and you can see that it is now firmly negative. I've been running this survey since the start of 2003. You can see the previous low was when we were invading Iraq in early 2003, and we've just completely blown through that. So businesses, households are in panic mode and significantly curtailing. So it almost feels like the world stopped in October, literally stopped in October, and you can see it in the data. The third link is the wealth, the evaporation of wealth. You know, economists debate the wealth effect endlessly. The wealth effect, the idea that people are less wealthy, they reduce their spending. It's kind of an intuitive idea, but economists debate the magnitude of this wealth effect. And I think the reason they do is because it's highly variable. It really does depend on the environment that you're in. But in this environment, I think people feel that they're worth less and that they will be worth less for a long time to come. This plunge in housing values, values aren't coming back anytime soon. And the decline in stock values also feels relatively permanent. So people really do feel that their nest eggs are smaller and that they will be smaller. And so the wealth effect, that relationship between their wealth and their spending, I think, is now going to be quite potent. And you can see it in saving rates. This is a calculation I've done based on the survey of consumer finance and the flow funds data based on a methodology some Fed researchers have put together. I've broken down the population into three groups. The homeowner group is the blue line. Excuse me, the renter group is the blue line. You can see they have a zero saving rate, but it's always zero. Really no change in behavior there. They account for 10%. They account for a third of the population, but only 10% of consumer spending. So a small part of the consumer pie. The green line, or let me go with the red line. The red line is the homeowner who has cashed out equity. In the last several years, they have taken out a home equity line of credit, a HELOC. You can see that they were huge savers during the housing boom and bubble, pulling out a lot of equity from their home, using that to finance consumption. Obviously, they can't do that now, so they have to match at very least their consumption with their income. You can see the saving rates have barreled towards zero and above. And then they account for a third of the population and about a third of spending, so roughly proportionate. The rest, the green line, that's the wealthier group. Those are homeowners who have not cashed out, no home equity line of credit. And this is the group that is now changing their behavior very, very rapidly because they feel like they need to. They don't have the nest egg sufficient to pay for their child's college education or for their own retirement. And this is a big group. This is the group that accounts for a third of the population, but 60% of consumer spending. And this is why Nordstrom and Neiman Marcus and Bergdorf Goodman are having a lot of difficulty because this group is battening down the hatches, and this is why we're in a recession. So it's going to be the next 6 months, in my view, are going to be very painful. 6 months after that are just going to be just painful. And the 6 months after that are going to be uncomfortable. It really won't be until we're well into 2010 until we can exhale, I think, and feel a little bit better about what's happening. Finally, third thing, all of this is predicated on the view that policymakers are going to remain very aggressive, that the Fed is going to be aggressive, and I think they certainly have, and will continue to be very creative in what they do. But I now think the Fed, to some degree, is coming to the end of what it can do. Now, effectively, can lend to whomever they want and buy whatever they want. They could buy a Picasso painting if they thought it would make a difference, and they probably will if it would make a difference. But I think we're coming sort of to the end. To some degree, the Fed is coming to the end of what it can really do for the economy in the near term. So it really is up to the new president. And I think three key things have to happen. One is, in my view, the TARP has to continue to make equity investments, but it needs to engage in some kind of asset purchases to determine prices in the mortgage market. Because without price discovery in the mortgage market, we're not going to get private capital coming into the banking system because they don't know what the balance sheet looks like and how much capital is really needed. So we need price discovery. And the TARP has got to do that either through reverse auctions or some other process, model-based purchases or whatever it may be, but we need that. It can't just be direct equity infusions because private capital won't come in. Second, we need a bigger, much bolder, comprehensive foreclosure mitigation plan. There's nothing that we can do to stop the price declines that are coming, but there is a very significant risk that house price declines are going to overshoot. And the reason is there are now 12 million homeowners by my calculation that are underwater, at the current time, and if prices fall another 10%, as I'm expecting, that would mean close to 15.5 million homeowners will be underwater by this time next year. And you mix in an 8% unemployment rate, that's a disaster. So we need to come up with a way of keeping homeowners, stressed homeowners in their home. And there are some good ideas out there. We just need to get that plan, a plan like that passed quickly so that we can keep people out of foreclosure and try to cushion the downside of the housing market. And we need a much larger fiscal stimulus plan than we got at the beginning of the year. When we got at the beginning of the year, included tax rebates and some investment tax credits that expire under current law at the end of the year. And I'm just showing you the economic impact on real GDP of the first stimulus package. This shows you the annualized GDP growth in the first half of 08, second half of 08, and now forecasts going forward. And you can see that the stimulus from the first package is now fading rapidly and will turn negative if we don't have another stimulus package that extends the investment tax credits that are going to expire. And then you can see my suggestion for a stimulus package now. A big package, $300 billion, 2% of GDP. First part of that should happen in the lame duck session, include infrastructure spending and aid to state government, which is absolutely vital, very rapidly, UI benefit extensions and food stamps. And then the second piece should be early next year when the administration takes office, and they can come in with a comprehensive tax bill and so kind of codify some of the things that the Obama campaign put forward during the campaign. And you see if we get that, then we do have a measurable benefit to the economy. But this is built into my baseline. Without this, the economic outlook turns extraordinarily dark very rapidly. We have a window. Interest rates are still low, even though we're going to have $1 trillion plus budget deficit in fiscal year 09. We better go through the window pretty quickly and take advantage of the resources that we do have. Thank you. Which one is your option?
Well, you weren't depressed enough. Let me add to your day. It's a pleasure to be here, and I thank Richard for the invitation, especially since I actually lived here in Princeton for about a year and a half between college and grad school, so it's great to be back. Right near the Hoagie Haven, as a matter of fact. I'm going to have to go check it out later. Okay, so what am I doing now? I'm actually an economist, and I'm director of the bank's regional affairs area. And from that, in this job, what I do is really pursue a mission, which is to monitor, analyze, and report on conditions in the district, and also to inform and educate people in the district about the economy, about the Federal Reserve, the region, and the financial system. So our district includes all of New York State, northern New Jersey, Fairfield County, Connecticut, Puerto Rico, and the Virgin Islands. And not Mercer County. You're actually in the Philly Fed, but what that means is that, in effect, New Jersey gets double coverage because both the Philly Fed and the New York Fed pay a lot of attention to New Jersey. So what I want to do today is, oops, let's see. Oh yeah, just use, oh, that's right. Yeah. Good. I want to start off very briefly by telling you what's going on in New Jersey, a very broad brush, take a broad brush look at that, then talk about non-prime mortgages and foreclosures, background on a more micro level, then talk a lot about servicing issues and talk about New Jersey conditions, and then go into the Fed response on this micro level. So, economic conditions in New Jersey and the region. The New York Fed actually has an index that tracks conditions in New Jersey. It's called our Index of Coincident Economic Indicators. We produce this monthly. You can always go to our website to get the latest one. And it's a real-time substitute for gross state product. So take a look at what it looks like. This is through September 08. The pink line here is New Jersey, and for comparison purposes, I have New York City and New York State there. Now, since the 1980s, New Jersey has been more stable than New York, but it had a similar overall growth. However, now this measure of gross state product is declining. It's been declining since July of '07, okay, and we can expect going forward that the kind of things that Mark was just telling us about the financial sector's cyclical impact and restructuring in the financial industry are likely to continue to depress growth going further. So if you take just that New Jersey number, and you can see that on the 1 month changes are much more volatile. So if you look at the 12-month change, what you can see is that the first negative monthly reading was in July '07, and so the first negative monthly reading was July '07. The 12-month reading has been negative since September '07. But since June '07, economic activity in New Jersey is down by 1.2% by this measure. Okay. So now let's go to talk about subprime mortgages. So what is the problem? What we have in subprime mortgages, and to some extent I think Mark framed it well, that the problem started in subprime mortgages, but much of what we're seeing in the subprime area is now spreading to other areas, to other kinds of mortgages, other kinds of consumer credit. What we have in subprime mortgages is a lot of borrowers with very few reserves in very high-cost loans. So the estimate as of March '08, this is actually a difficult estimate to make, so that's why I still have a March number here. 6.7 million subprime loans with a $1.2 trillion balance were outstanding at that point. Our foreclosure rate now, as of September '08, is about 11%. So about 11% of those mortgages means that a first foreclosure notice is in effect for them. Okay, refinancing for people in those loans is very difficult because they have very little equity or none in their home, and the credit crunch has, at any rate, reduced refinancing options. So you get the adverse feedback cycle that the defaults and the credit crunch and the path of home prices are all clearly related, feeding on each other. And as this cycle continues and the economy slows, the defaults are spreading to prime mortgages, credit cards, other kinds of consumer debt. So what I'm going to do now is focus on the epicenter, subprime mortgages, and talk about what the characteristics are of this, why this isn't resolving maybe as fast as we might like it to be. So how did we get here? I assume that all of you know a lot of this now, so I'm going to run through this very quickly. The subprime business model is one where borrowers with very limited means or other problems can get a mortgage, but they pay very high interest. The idea is they can get it a little bit earlier than they would have otherwise. They pay high interest until they can refinance on better terms. Right? This model has been in place for a long time, 30 years plus. What was different was that in the early 2000s, we had a vast explosion of this. It was in place in loans being held in portfolio, right? But in mid-2000s, they started to be securitized, and so we had a number of accelerating factors. We had high sustained home price appreciation. That raised the apparent attractiveness of investing in home equity. We had a lot of novel loan products and underwriting options that widened eligibility and also attracted borrowers. Right? And then we had securitization, which, as practiced, apparently weakened incentives for strong underwriting. Right? And a couple of my colleagues, Adam Ashcraft and Till Shoreman, have a very interesting paper called The 7 Deadly Sins of Securitization. Can take you through all of those. Okay. So subprime lending grew dramatically from '01 to '07, to the point that in 2006, 24% of all mortgage originations were subprime loans, and that's up from 6%, which had been pretty stable for the 30 years before that. Okay. And then we had, of course, a very high early delinquency rate in the later vintages particularly. Now, falling home prices and the tighter credit conditions are impeding refinancing. So, this is a picture of various delinquency rates, 90-day delinquency rates for adjustable and fixed-rate mortgages. And you can see the solid lines show the serious delinquency rates. The dotted lines show the foreclosures started, and you can see that they are just heading up and up and up. Okay, so what are this? So we have a lot of distressed mortgages sitting at servicers now. So what is a servicer? A servicer is the point of contact between the borrower for the borrower. They manage the mortgage. They work for the investors in a securitized loan. They work for the investors, and they service the loan. We have a broken servicer model. These servicers are companies that are squeezed between rising cost per loans and static revenue per loan, because they are paid essentially a flat amount for a loan, whether it is in foreclosure or whether it's performing normally. But a loan that's delinquent or in foreclosure is much more expensive to manage. They have rising delinquency, default, and loss severity rates. So we are up, as Mark referred to, losses on a loan that go into foreclosure are around 50% and have been climbing. These servicers have no new performing loans, but their model was built on thinking that there was going to be a lot of flow-through loans, right? And the best loans, of course, are the ones that can refinance. So they are servicing more and more bad loans. No one's coming in to balance this out. So they're under a lot of cost pressure, and therefore they don't have a lot of incentive, actually, to increase their capacity, but that's actually what might be needed now. So what are the restraints on innovation and efforts in modifications, loan modifications, to try and restore these loans so that they're performing again, so that people can actually pay them? Well, servicers' compensation is not based on borrower performance. It's a flat rate no matter what. The effort and the quality of the servicer's efforts can reduce losses, but actually putting out that effort, improving quality, is very costly to the servicers. Usually these modifications, if they make them, must follow standard industry practice. That means that, and that's not well defined, but the pooling and servicing agreements under which the servicers operate say allow the servicers to make modifications as long as they conform to industry practice. Well, that's essentially a backward-looking measure of of activity. So when you're in a very dynamic situation like the one we are now, it's very hard to move the entire industry forward. All right, and particularly principal reductions, when they are allowed at all, are often limited to 5% of the size of the pool. Principal reductions are particularly interesting because that's a way by which you restore the incentive to pay on a mortgage. Okay. So the incentives that servicers face also favor reimbursable activities, such as foreclosure services. Those are usually outsourced by the servicer, right, over the things that are not reimbursed, which is their core activities, which is the labor cost of actually doing a loan modification. Servicers also face divergent interests among the tranches of widely dispersed investors in these loan pools. So if they're worried about being sued for over-modifying loans, and some of their investors are going to, if you're a very senior investor, right, then you might favor certain kinds of modification, right, where that junior investors would not favor. So a junior investor is, one in a junior tranche, is going to get much less, if you do I'll give you an example, if you cut off, If you reduce principal, then for sure you are reducing the payoff to your most junior investors, right? But you might increase the payoff to your more senior investors. So they have divergent views. So the servicer then if they fear being sued by certain parts of the tranches, right, then they're more likely to not do anything radical or different because they don't want to open themselves up to that. Okay, so another issue that you have is that many delinquent borrowers are very difficult to contact. This is a very stressful time, and the problems that they get into are often distract them from responding to servicer outreach. They believe that nothing can be done. They're embarrassed, something like that. So there's an estimate out there that half of homes that go into foreclosure, half of homes go into foreclosure with no contact between the borrower and the servicer. And in addition, junior liens, holders of junior liens second liens can hold up short sales. Okay, so a short sale is a way to avoid foreclosure where the home is sold for less than the value of the mortgage and the mortgagor agrees to accept the sale price in lieu of the whole principal of the mortgage. So it's a kind of workout where the borrower leaves the home but doesn't owe the balance. Junior liens can hold that up because they have to agree to resolving the obligation of the borrower. So mortgagors very often, when they're overwhelmed to begin with, will put at the end of the tend to avoid work or delay work on homes having second liens that are not held by the same people. Okay, so the current approaches to workouts are basically standard industry practice. By default tends to be what Fannie Mae and Freddie Mac require. This is a moving target that involves case-by-case review, and it's very time-intensive, particularly when you're talking about a no-documentation loan that essentially has to be re-underwritten. Okay. In order to move things a little bit forward, you've had the Hope Now initiative and activities on the part of the American Securitization Forum. So this is a way for all of the servicers to agree on things they are going to do to move forward the standard industry practice a little bit more rapidly. This involves outreach efforts, counseling, of course, and the teaser freezer is an example of that. That's a modification that all of the servicers have as an option to start enforcing, and most of the biggest servicers are doing that, but not that many of the loans actually comply with the terms. Okay. There are other approaches to workouts. There's the approach that the FDIC is taking with regard to the loans that are under their purview because of the failure of IndyMac. This is a program to modify loans without a full re-underwriting process. All right. And because I'm running out of time, I'm not going to go through that. But basically, they just look at the origination information and they mail an offer to delinquent borrowers and say, how would you like this? If you would like it, send us some money, sign this form, and you'll have your loan modified. Okay. It is mostly about reducing interest rates and extending terms, but there's some principal difference. Okay. People are skeptical about it for some reason, for a number of reasons that I list here. The FDIC is considering expanding this further. The press reports some characteristics of what they're thinking about. None of this is actually fully decided yet, I think. And the FHA has two refinancing options, one that's been around for a while, which offers low interest rates, but very few people qualify for it, and then the much broader applicability Hope for Homeowners program, which involves principal reduction, but shared appreciation after that. So it may not be too attractive to people. Okay. What I want to now tell you about very quickly is what New Jersey looks like. In general, there are a lot of regional variations in subprime lending. There are two faces of it, the places that had the rapid boom and bust and the places that were overall declining. So boom and bust in California, Florida, Arizona, Nevada. Overall declining, we're talking about Cleveland, Ohio, Des Moines, Detroit, etc. New York, New Jersey have lower than average incidence of subprime loans, but higher than average incidence of foreclosure rates. That's probably largely because of the long time that it takes to foreclose on a home. Okay, and there's very high variation in both levels and delinquencies by region. So it's everywhere, but it's highly clustered. So to give you an example, this is the share of owner-occupied subprime loans in foreclosure by state, and you can see the three clusters, the pattern that I talked about, California, Florida, and then the Rust Belt areas as having high impact. And New York, New Jersey, you see also. Okay. If you look at the changes, you see that red means things have gotten worse. Most of the country, things have gotten worse. Okay. If you look very closely by county at the tri-state area, you can see that there are a lot of variations by county level, and I've pointed out some of the counties with the highest level of foreclosures here. You can take a look. Mercer looks pretty good there. At the zip code level, within counties, there's a lot of clustering. This is focusing on two counties in New Jersey, Essex and Union County. And you see about 75% of foreclosure activity is within about a third of the zip codes. So while these foreclosures are everywhere throughout the country, they are also tightly clustered. So they're not necessarily in your neighborhood, but they probably are in your county. Okay. Response, I'm going to run through this. The Fed has a broad response that encompasses four things: regulation, financial education, research analysis, and outreach. And I'm really running out of time here, so I'm going to have to just run through this. But let me tell you you just saw the maps that I showed you. Those are actually up on the website, and we on the New York Fed website. Our goal here is to help regional stakeholders, that's state and local governments and nonprofits, target the resources to address these areas of distress by making private data public. So we've been purchasing private data and converting it into these dynamic maps so that regional stakeholders can understand the impact on their areas. You can take a look. They're kind of fun to play with. They have information on a lot of information on subprime loans. We've recently added delinquency rates for all mortgages, as well as credit card delinquencies by county to this website. So an example, this is the U.S. view of our subprime maps. There are 12 different characteristics that you can click on, and you'll always have the latest months there. And there are also 12-month changes. There's 6-month changes on this one. Okay, you can drill down to the state. There's New Jersey. And within each county, you can look at the zip codes within the county. So we have these maps. We have a number of other things, which you'll be able to see later. I'm really out of time here. Okay, so my conclusions are that economic activity is slowing, that mortgage conditions in New Jersey are as I described. We have a broken servicing model. We have a Fed response that's focusing on this on the micro level, and success will be about effective resolutions for distressed homeowners, because that's the core of the problem. And then from there, of course, the stable, well-functioning financial markets and institutions that accompany it. Thank you.
So I'm going to be so brief that I just am going to invite you to stand up for 90 seconds.
You don't have to worry about Q&As.
Okay.
We can take all the way.
I want to talk about 8 or 10 minutes. So that's I'd rather reserve it for questions. Yeah, fine, that's good. Don't go too far.
Big enough? Maybe you want to hit that little, would that make it bigger?
Yeah, so how do I do
I'll move the arrows up and down.
Okay.
But I think we wanted to make the whole screen.
This area,
This one is here. Yeah. So wait a minute, and all that other stuff disappears.
There we go.
All right, we're going to get going again. I'm going to hit David on the head.
Well, we can go. We got plenty of time. Yeah, we can go.
All right, the roll is over.
So you can't get money. Go ahead and start speaking, otherwise we're going to be late on. That's it. That was really very good. I'll get them back in.
I think the advantage of this kind of thing is that you can build on people's attention. So you can get through a lot more material than just.
Thank you very much. I very much appreciate the opportunity to appear on the panel. It's always really good to be on a panel. I'm very proud of the Federal Reserve System, and so I especially enjoy being on a panel with a colleague because I think it demonstrates a lot about the collegiality that we have that makes the Federal Reserve just a different organization than anything else I've experienced. But with all due respect to Eric, I have to say that the panelist that I was really tremendously excited being on the same panel with was Mark Zandi. It has nothing to do with the fact that he's a rock star. He gets on NPR and that sort of thing. But being somebody whose last name begins with a W, I was tremendously excited to panel with a Z, and then it didn't work. So I'm last. I am going to be very brief, partly because the topic that I'm assigned to talk about is very much a work in process. And whatever I say today, the less that I say today, the less will change tomorrow. So what is this TARP, and what problems is it intended? What are we trying to accomplish? Well, we have several objectives in mind. We're not trying to cure all ills, but we think that the Congress gave us a specified mission, and that is to restore market functioning and to support viable financial institutions. All of that we're undertaking with an eye toward trying to promote the recuperation of real activity in order to cushion the effects of the kinds of risks that Mark was talking about. And we want to do that with an eye toward investing taxpayer resources wisely. There is a recognition that we are going to take your resources and invest them. That's what the Congress asked us to do. The Congress did not ask us to undertake either a risk-free strategy
or a do-nothing strategy. So we are going to take your resources and put them to work. Part of that will entail undertaking some risk on your behalf, but we are going to try and do that in a way that we think reflects what you would do if you were in our position and trying to make the situation better. We have a variety of possible mechanisms that we can use and are studying intensely about how to do that. One of those we have already put into place, and that is injecting capital into financial institutions. I'll come back to that in just a minute. But other tools that are available to us under the legislation are buying financial assets. We can provide guarantees or insurance on financial assets, or we can undertake strategies that are specifically designed to try to facilitate mortgage modification. So just a word about what our statutory authority is. The main clause that everybody focused on as the foundation for what Professor Shin referred to as TARP 1 is the first clause that I show here, which states that the Secretary of the Treasury may purchase mortgages and related instruments. An interesting aspect of that clause was that those instruments had to exist as of a specified date, March 15th of this year. And the reason for that was there was a sensitivity to the fact when the legislation was drawn that we didn't want to provide the kind of incentive that Erica referred to for people to undertake adverse behavior for the sake of qualifying for a program. And so the way that the legislation was designed was to try to provide a defense against that, to say, well, the loan had to be in place as of some particular time before it would be eligible for purchase. There was a second clause which provided an enormous amount of flexibility, and that clause said that the Treasury Secretary could purchase pretty much any other financial asset that he determined in consultation with my boss, the Chairman of the Federal Reserve. And if the Treasury Secretary determined in consultation with the Chairman of the Federal Reserve that asset, the purchase of that asset is necessary for the promotion of financial stability, then that asset can be purchased by the TARP. Now, the Congress put an outer boundary on the size of the TARP, and it said you have essentially, actually the scoring of this outer boundary turns out to be a topic unto itself. But basically think of it as $700 billion worth of capacity. When we purchase these assets, Congress put in place a set of rules that govern some conditions that have to be applied to the entities that sell us the assets. These rules govern executive compensation restrictions, and we have to take warrants as part of the transaction because the Congress wanted the taxpayer to have some upside potential as part of the transaction. And in addition, the Congress implemented just an amazing array of oversight in recognition that there was an amazing amount of resources here that were going to be put to use very quickly, and therefore the controls needed to be very tight. The oversight and accountability needed to be basically platinum quality in this undertaking. Boy, $700 billion, that puts the TARP on the map in terms of world countries of GDP. It's like expending the GDP of a medium-sized country with a targeted purpose and in a timely fashion. Getting that accomplished is just a monumental task, and sort of the first hurdle that had to be crossed was to get an organization stood up when nothing existed before then. And the Treasury Department, which is the lead agency in implementing the TARP, took, I think, a really smart strategy here, which was they seeded the organization with one of their own people, Neil Kashkari, as the director of the effort, and then about half a dozen very senior people from different agencies around the federal government who they brought in on a temporary basis. And one of their first assignments is to hire their own permanent replacement, work themselves out of a job after a small number of months. But they had to be, they would have sufficient understanding of their own responsibilities that they'd be very qualified to recruit the permanent replacement who will staff the organization going forward. As I mentioned, we've accomplished the first step. We've put to work a total of $250 billion or made it available for capital to certain qualified institutions. The basic model is we said that for entities that are solid enough for the financial regulator to determine that they can be in operation, the federal government will invest in equity. And the equity, the particular form of equity that we will purchase is what's called preferred equity. And the terms of that are that the Treasury, the taxpayer, you, will be getting a 5% dividend yield on that preferred equity for 5 years, and then the dividend yield will step up to 9% on the 5th anniversary. And in addition, in fulfillment of that restriction that I mentioned earlier, the Treasury Department will get warrants with a value equal to 15% of the equity that we purchase. And then, as I said, we have to impose certain restrictions on executive compensation. And then, interestingly, the entities that take capital under this voluntary program have to also submit to some restrictions on share repurchases and dividend policy. So, in particular, they're not allowed to increase their dividend payments during the first 3 years without the permission of the Treasury Department, and they're also not allowed to undertake share repurchases, because what we don't want to do is put the capital in through the front door and then have them send it out through the back door in the form of a share repurchase. So they can't do that without the permission of the Treasury Department. The first tranche of $125 billion has already been put out to 9 large financial institutions. That was done at the end of October. And we've made $125 billion available to the other qualifying institutions. These are basically banks, savings and loans, and related institutions. One thing that was an education to me is just how many species of banking organizations there are. Chairman Leach referred to one of those little-known species, the industrial loan corporations. But there are different forms of organization of a bank. As a macroeconomist, I thought, gee, banks have shares that are traded on organized stock exchanges. That's true for a lot of banks. But there are thousands of banks that don't take that basic form. There are thousands of banks that are organized according to S corporations or that are privately owned banks. And so what we've had to do is devise a different way of handling those different forms of corporate organization. So while we've gotten a quick solution very fast out into the marketplace for the type of bank that I think most of us would have thought of as being a bank, it's been a harder go for these other forms of organization, but we're working on that. A critical decision that we wrestled with a lot, and I'd be happy to address it during the Q&A, was who are we going to invest in? And how restrictive should we be in the standards that we apply to the institutions that we're going to invest in on your behalf and for the purpose of, hopefully, as I said, supporting real economic activity? There's a range of really interesting issues there involved in that decision. So as I said, one of the challenges on capital injection is getting the rest of it done for these other forms of organization, and just dealing with thousands and thousands of organizations, each of which has a reasonably complex legal agreement that has to be put in place is a real logistical challenge. So that's up to $250 billion. You can do the math. That means there's $450 billion of capacity that remains as yet uncommitted. So what do we do with that? Well, what we'd like to do is establish a set of priorities that will help us accomplish those objectives that I started out with talking about. And here I've listed a few of the possibilities. We could do more capital injection. We think we've seen some beneficial effect from the initial round. The losses, as Mark has emphasized, are very great. Are there ways that first round of capital injection should be modified in a second round? Should we make the capital available to a broader range of institutions that are also important for supporting real economic activity? Another possibility is that instead of providing capital to financial institutions, we could purchase assets and bring them directly onto the balance sheet of the federal government. The basic rationale for doing that is that many of those assets are, as Mark said, they're either thinly traded or there is simply no trading whatsoever. And so they create a sort of aura of opacity. Nobody can see through these assets to see what those assets are worth. And by extension, nobody can see what the institution is worth that's holding those assets. So if we purchase those assets at a price that we think represents a good value for you, take them off of the balance sheet of the private institution and onto the balance sheet of the federal government, and replace those opaque assets with either cash in the first instance, or after the money gets lent with an asset that has a more transparent value, then that might make all I'm going to use a term of lingo here, all the counterparties of that bank might become a little more relaxed about trading with that bank, because they say, now I see there's more clarity, more transparency about what the balance sheet of that bank looks like and what the bank is fundamentally worth. The world is an uncertain place. We know that accidents are very likely to happen because the financial situation is very fragile, so we want to reserve some of these resources for the bumps that inevitably will come. A high priority is thinking about strategies for foreclosure mitigation and whether TARP resources should be used to promote foreclosure mitigation, and certainly I have not exhausted here the possible range of uses to which TARP resources could be put. One lesson that comes out of this, which I find astonishing, and I have to swallow even before I say it, is that $700 billion today looks a lot smaller than it used to. As the problem grows bigger, the budget seems more confining. And so I think one critical issue for the Congress and the incoming administration to think about is whether the available pool of resources needs to be expanded. And I've listed a variety of possible strategies for expanding those resources. And I think that's it. Thank you very much.
We're running a little bit behind, but why don't we take 5 minutes, no more than that, to some questions, please. Over here.
Yeah, I had a question about, it seems like all things protected by conditions of investment. It seems like the public interest is protected by the conditions of the investment, except that banks will continue to pay shareholders dividends, and some of your money may be going out to common, ordinary shareholders like me. And, I wonder if that's an appropriate thing to do. And the second thing is, you don't have any control over what the banks do with their money. And, there's all this stuff now you read about buying other banks. And I can't really understand whether that's good or bad as far as the public interest is concerned. Maybe some of it's good, but they don't seem to be loaning with the money you're giving them. They seem to be, improving their own ship, as it were.
So I don't have anything like a complete answer, but let me give you a few pieces of the answer. They're not going to add up to a satisfactory whole. With respect to whether banks are lending with the money or not. So I'm an economist, and we're trained to think about what would the world look like in the absence of this $250 billion, up to $250 billion having been provided. We don't know the answer to that. We think the world would look worse. But what's quite clear is that these institutions are in a very defensive mode. And what we're hoping is that the provision of that capital at the margin will accomplish two things. First of all, banks understand that capital that they stuff under their mattress doesn't earn a return for their shareholders. And that the way they're going to earn a return for shareholders is put that capital to work. So we haven't actually completely given up on capitalism. We have a basic faith that the profit incentive is still there and has to be a fundamental component of the way that we evaluate the situation. Secondly, as we put that capital out into the banking sector, again, at least relative to a world where there was $250 billion less of capital, what we hope and expect is that each and every, these banks and financial institutions have lots of complicated interactions among themselves, and they're always trying to look at their neighbor and say, are you a safe counterparty for me to interact? Are you a safe counterparty for me to interact? And one thing that's causing the whole situation to seize up is that lots of people are concluding that institutions that they thought were safe counterparties to trade with were not. Well, what we're hoping is that that additional capital will just help the system take a deep breath and cause people to reevaluate the risks that they undertake. It's a really delicate question. One thing I can tell you for sure is that we're implementing the law as it's written by the Congress, and the Congress didn't put any explicit requirement in there that you have to go out and lend, and it's not difficult to imagine a sort of heavy-handed requirement that thou shalt go and lend. It could go terribly awry. After all, it was a sort of overcompulsion to lend that was one of the seeds of the current crisis that we're in now. And so we really need to be very careful, I think, and sensitive to how we approach this topic of what banks do with the capital.
Reserve adjusts interest rates from time to time, and it looks like they may go down again. What happens if it goes to zero and all of a sudden the psychological impact of adjusting interest rates is lost? Does that make the Federal Reserve much less a player in dealing with economic conditions?
Well, so one on one dimension, I think it's entirely correct. It's just a mathematical fact that we're now 150 basis points from being, quote unquote, out of ammunition. There are many other actions that the Federal Reserve can take. So one slight shading of difference is we are not out of the policy game. Monetary policy is conventionally conducted, has been applied aggressively to this point. The funds rate has been brought down by a lot. But We have a lot of other tools, and then, as the other speakers have emphasized, the Federal Reserve and monetary policy are not by any means the full range of tools and capabilities available to the federal government.
Question over here.
Yes.
The financial rescue package was relatively vague. It gave a lot of discretion to the Secretary of the Treasury. And, of course, not as vague as it started out. But I think many of us in Congress feel that the Secretary and those implementing the plan have shown better judgment and good discretion than they were required to in the legislation. Now, I hesitate to ask a question because I don't want to imply that Congress is going to take further action. But if Congress were to revisit the plan and impose more guidelines or to say that the committed amount of $250 billion or soon to be committed amount would be the new cutoff, and there would be a different package beyond that. I wanted to find out what would you say are the limitations on tampering or tinkering with the rescue package. In other words, what commitments are made, what restrictions are in place that would make that would limit the ability of Congress to change what is in the $700 billion package.
So I'm not going to give you a satisfactory answer. I'll mention three things and then let my colleagues address it as well. First of all, if I can remember the three, I've just forgotten one of them. Keynes had a famous saying that when the facts change, I change my mind. I think a hallmark, I really do think that what can be characterized as vagueness is can also be characterized as flexibility, and that as the circumstances have changed and the situation has deepened, that there has been I think, laudable willingness to fundamentally rethink the architecture. And frankly, it takes some courage to say, the plans that we had laid out provisionally for you a few weeks ago, those are plans that we're going to put on the shelf for now. There's been no final decision that those plans won't be taken off the shelf, but we're actually going to reinvent this thing, which is only a few weeks old, reconceive it from the start, because now we think the circumstances on the ground have changed. So I guess the first thing I would say is that if and as the Congress revisits the package, that high value be placed on flexibility. This requires an element of, I think, trust between the legislative branch and the executive branch, and accountability. And I think for that reason, I think the high level of accountability that is provided in the original legislation is entirely appropriate, and that I think establishing a situation of trust but verify is a pretty good way for the Congress to empower the executive branch to act as its agent, and that the Congress obviously should specify as clearly as it can what the objectives are, but then leave as much flexibility to the executive branch to implement it, subject to vigorous oversight.
Well, I wasn't questioning the discretion that was given to the Secretary, and I was commenting, by the way, that I exercised it well. It'd be 5-1. But the real question is, what would be the limitations on restructuring the rescue plan if Congress wanted to do it?
So I'm not sure that there would be substantial. Those remaining funds are uncommitted, so I think it would be. I can hear my general counsel in the back of my head saying, "Do you really sure about that?" But I think it. So I'm not a lawyer. Besides, maybe a little time off in jail would be an easy way to go at the moment. But I think it would be entirely within the purview, obviously, of the Congress to come back and say, "You haven't committed those funds. We want to come back and impose a different set of restrictions on the use of those funds. We see a different mission. We want to adjust the parameters so that the program plays out differently." So I think that's entirely within the purview of the Congress to do.
Well, thanks very much. This has been a very stimulating session. We've hopelessly overrun, but hope we can make up for some time.
Thank you.